I didn't make money in trading for 4 years and I was on the verge of quitting until I discovered this simple trading model. And the moment I discovered it, within 3 weeks, I was a consistently profitable trader. So in this video, I'm gonna show you what that model is and more importantly, how you can become a profitable trader too. Okay, so for this model, we only need 2 things, right? We need a liquidity sweep and we need a fair value gap. Now, if you have no idea what a liquidity sweep and fair value gap is, make sure you go and watch this full free 2-hour trading course, which tells you literally everything you need to know to become a profitable trader, right? But for the rest of you, I'm assuming you know what a liquidity sweep is, or at least you've heard of it, and a fair value gap. But what a liquidity sweep really is, right? It's essentially a stop run, right? It's a stop run before price quickly and aggressively moves in the opposite direction. And this must have happened to you all the time, right? How many times does this happen where you know price is bullish, right? You've got your daily bias, right? And then price comes down and you want to enter somewhere here, right? You want to buy the dip or enter some sort of fair value gap and Fibonacci retracement order block. And then price comes down like this, takes out your stop loss, which is here, and then quickly and aggressively moves off straight to your take profit. The reason this happens, and this used to happen to me all the time, the reason that happens is because you're not waiting for something called a liquidity sweep. Liquidity sweep, simply, all it is just a stop run. And you can see right here on GBP USD, and this happens in all markets, especially indices, but happens in forex a lot too. You can see right here is our liquidity sweep, right? So let's mark this out. Right here, price comes down, and so many traders, and this was exactly what I would do, so many traders would see this bullish move on GBP USD, they'd see the fair value gaps here, they would try and buy price here, they would buy price here, they'd put their stop loss right there. Price would come, wick out their stop loss, and then quickly move off straight to their take profit, right? Because these traders here haven't waited for a liquidity sweep. You've got to wait for a liquidity sweep, right? If you don't wait for a liquidity sweep, you're going to lose so many times and you're not going to be profitable. And just waiting for a liquidity sweep alone, that was the one thing that made me profitable, right? If that's one thing you take away from this video, just wait for a liquidity sweep, right? Just wait for a liquidity sweep before you enter. But the highest probability trades always occur after liquidity sweeps. So we've got our fake move here, designed just to take out stop loss orders. Then price moves off in the real direction. Now we want to enter on any sort of retracement, right? Now we want to enter any sort of retracement. Now, lots of people ask me this. Lots of people get confused. They say, oh, how do I know this is a liquidity sweep? Like, how do I know price is going to quickly and aggressively reverse like this rather than coming all the way down like that? Now, you don't know that. You don't know that until price shows you that, right? That's why we want to see price quickly and aggressively move off in the opposite direction. And once we've got a liquidity sweep, all we need is a simple entry pattern. Now, I think a fair value gap is probably the simplest entry pattern. And for those who don't know, fair value gap is literally, you see the gap between this wick high here and this wick low here, right? That's all a fair value gap is. So what you're going to do is you're going to mark out your fair value gap like that, right? And this is how you can determine that price is actually a liquidity sweep. If you get a fake move down like this and then price starts leaving fair value gap in the opposite direction, that's how you know it's a liquidity sweep, right? So always wait for a fair value gap. If price does something like this, and you've probably seen this before, where it kind of wicks it out and then it's kind of like choppy, it slowly moves up like that, that is not a liquidity sweep, right? We want to see quick and aggressive, strong moves in the opposite direction. And the way of seeing that, the way of determining it, is just to wait for a fair value gap, right? Wait for a fair value gap, enter on the fair value gap, and ride price up. Now, I know you're probably thinking, right, like, oh, there's another fair value gap here and here. When you are bullish, and this will be your notes, when you are bullish, always wait and always take the lowest fair value gap, right? And when you're bearish, you just flip it on its side, you take the highest fair value gap. But when you're bullish, always take the lowest fair value gap here. Now, I know, some of you can be like, oh yeah, what happens here? See, if price comes to this fair value gap, right, like this, what if price does this? And you've probably seen this, flips the fair value gap and goes off like that. Listen, you missed a move, right? You missed a move. And this is why, I'm a big believer in having multiple currencies to trade, right? Have multiple pairs, and then you can choose the best pair on the day and, take the best setup possible, right? So for this model, what you're going to do is you're always going to take the lowest fair value gap, here. And then at this point, all you're going to do is set up your entry. And the reason why we always set the lowest fair value gap is we have to put our stop loss at the liquidity sweep low. Now, I know so many of you want to put your stop loss right here or even right here, right? You want the tightest stop loss possible. But the whole point of us waiting for the liquidity sweep is so we can put our stop loss there, right? What is the point? What is the point if you enter all the way up here on the fair value gap and your stop loss is like here? What is the point in waiting for this liquidity sweep? Because price could easily come down here and take you out and then go straight to take profit, right? The whole point of waiting for liquidity sweep is that we can put our stop loss in a safe area, right? A safe area where we know that it's very, very unlikely that price is going to come to. So that's why we always wait for liquidity sweep and we put our stop loss at the liquidity sweep low, right? That's all you need, literally, to become a profitable trader. And then for take profit, you're going to target at least a 2 to 1, like this. But for me personally, I always target a free risk reward ratio like this, right? Like this. And then you just let price do its thing. Let price do its thing. Like that, right? Like that. Wait for the entry. Wait for the entry. Bam. Just like that. You wick in and then price goes straight to your take profit. Now, if you notice here, it just makes it a bit clearer. Right here, we missed the fair value gap entry. Now, this depends on the broker. Different brokers will give different prices. So depending on, like, you know, if you go on your MT port, whatever platform or whatever platform you use, this wick here might have hit the fair value gap. But the second one, we get in the fair value gap, and then we let price do its thing, right? You'll see the strongest moves always happen after a liquidity sweep. That's literally all you need. All you need to become a profitable trader is a liquidity sweep and a simple entry pattern. That is it. And that took me, sadly, it took me 4 years of hard work of being an ICT chart student to finally realize that. And this model I've given to so many students, and so many students are making money with this. And to be honest, if you combine this trading model right here and you watch this full free 2-hour training course, you'll become a profitable trader in 3 weeks. So I'll see you in that video over there.